Okay, good evening, everyone. Welcome to tonight's webinar. My name is Abigail, and I am your host tonight. So before we start, I would like to do a sound check. If you can hear me, I'll just select. Okay, if you can hear me, please tick yes in the poll. Okay, great. So as usual, we'll start with the disclaimer. I'd like to emphasize that whatever we share tonight is just for general information, and it does not constitute any recommendation to buy or sell any investment products. So if you want to invest, you shall seek advice from a qualified financial advisor for making any investment decisions. Okay, for those who are new tonight, here's a little introduction about our company. Our company is called Phillip Futures, and we are a wholly owned subsidiary of Phillip Capital, and we're incorporated in the year 1995. So Phillip Capital is our mother company from Singapore, but for Phillip Futures, our headquarters is based in KL, and we have branches across Malaysia, such as in Kota Damansara, Johor, Penang, Malacca, and as for East Malaysia, we have branches in Kuching, Cebu, as well as KK. Phillip Futures is a trading and also clearing participant of Bursa Malaysia derivatives. We are also a holder of the Capital Market Services License, which qualifies us as a legal and regulated broker in Malaysia. And last year, we are very proud to win 3 awards by Bursa Malaysia as the first runner-up for the best overall, best retail, and best institutional derivatives trading participant. And we'd like to thank our clients and also appreciate them for their trust and support in us. And because of that, we are able to win these recognitions. And for our mother company, Phillip Capital, we have a wide network around the globe. You can see from this map here, we have offices in over 14 different countries as pointed out. And as for futures, we also provide products listed in other exchanges from US, Europe, Japan, Hong Kong, Singapore, and so on. So with our global coverage, clients can trade both the local and also foreign products within the same platform that we offer. So in Phillip Futures, we offer 2 main line of products. One is futures, another one is CFDs. So for futures, we allow our clients to trade different categories of products such as interest rates, futures, index, energy, agriculture, and also metal futures. But tonight our webinar will be talking about US indices, so we will be focused on the index futures. And for those who also trade the stock market, we also have CFD or contract for difference. Okay, we offer Bursa and also US shares CFDs as well as the US indices CFDs. So these products are offered at very attractive margin. If you're interested to know more, you can always contact us. Okay, next, why trade with us? Okay, first, we offer 24 hours broking and also execution support for our clients. You can call in our dealing desk if you need any help regarding your trades and also regarding your accounts. Yeah, and next, we also send out latest market news and commentaries exclusively to our clients on a daily basis through email. And then we also provide a wide array of products that allow our clients to trade both the local and foreign products, as I mentioned earlier. And then lastly, we also provide advisory service on what kind of products you want to trade or how you can get started on trading. And other than that, Phillip Futures will also provide a free one-to-one coaching sessions, free webinars, and also free account opening. For account opening, is entirely free. All you need is just to fund in a minimum 1,000 to activate your account, and you can use that money to trade later on. Okay, our free one-on-one coaching sessions are targeted for beginners. So we cover topics like introduction to futures trading, product knowledge, platform coaching, and also charting system. If you do need this kind of coaching sessions, you can also approach our representative or dealers. We can make an appointment to have this session with you. And also, just for your information, we are the first broker in Malaysia to introduce this online account opening. So we allow our clients to open an account at ease and also in convenience lah. So if you're interested, you can scan the QR code. It will take you directly to the online application. Yeah, so basically it just takes you like 10 minutes to fill in the particulars. You just need to upload some documents for verification, and then you're good to go. Yeah. Okay, next is our platform. I'd like to introduce to you our platform called Phillip Nova. This is our in-house trading platform that we use. It is also a web-based kind of platform. So basically, you can just log in like how you log in your Facebook, and then you can trade already. All right, our platform has over 90 indicators. We have live charts, so you can also access both the local and foreign products. And we also have a demo account for you to try out. If you're interested, you can scan here the QR code here to register a demo account to try out or check out the interface. And we also have a mobile app version for those who like to trade on your mobile app. You can just download this Nova app from your Google Play Store or your App Store, and then you can get all the same features and also live charts inside as well. Okay, just a little bit. I'd like to promote for you our promotion that we are currently running. So this one is the Trade CME Micro Futures at USD 250. So basically for this, you can trade micro-sized US indices, silver, and also US Treasury yield at a very low rate of only $2.5 per lot per side lah. So micro products margin are actually usually 5 to 10 times smaller than the usual standard contracts, and it is a very good opportunity if you like to diversify your portfolio or try out the US markets, because micro contracts give you the flexibility to scale your positions and allow you to be more nimble in your trading. And with only USD 250, it is also easier to break even as well. So yeah, if you like to register for this promo, you have a QR code here, or you can also contact our dealers if you have any inquiries. Okay, before we dive into our topic tonight, let me introduce you to our speaker, Mr. Daniel Ang. He is a trader and also an author of with 37 years of experience in the futures market. He is very well versed in trading the US futures, and he will share more with us about that in a bit. So we are very honored to have him on board with us tonight. So to the audience, do seize this opportunity to ask him any questions if you have regarding the markets, and you can drop your questions in the comment box, and we will address them later at the Q&A session. All right, so let us welcome Daniel.
Hi, good evening, everyone. And today is May 25th. We are already into the last stretch for the month of May. So time's really very flies. And we all know over the last few months, if you have been very active reading the news or watching the broadcast, like, any kind of financial program or channel, you'll be hearing this thing very often, this thing called inflation. So this is the major theme that's driving markets right now. So we want to be aware of what this inflation is all about and how it might impact equity markets, and then what the Federal Reserve is doing to counteract this ramping inflation, and both the effect of the inflation as well as the action taken to control inflation will have immense implications for equity markets going forward. So this will be the major theme running for the rest of this year, even maybe as long as next year. So do be aware that these are the issues that is facing markets today. Now, let me begin by sharing my screen with you. I hope you can see my screen. Let me see. Can you see my screen now?
Yep, can see your screen.
Okay, that very good. Now, I know Abigail has actually given you the disclaimer. I would have to do another one. This is basically to remind all listeners that this is not a presentation about asking you to buy or sell any securities. Definitely the trading of any kind of leverage products like a futures contract is by itself carry an element of risk. So do be aware that when you trade leverage products like futures contracts, there is always the risk of loss. So be very aware that your own risk profile, you understand your own risk suitability before you embark on trading any of these leverage products. Now, later on, there will be a segment in which I'll be sharing with you my opinions. And these, again, are my opinions. I'm not asking you to buy or sell, but I will sharing with you my views and what I may do going forward as far as the US equity derivative futures is concerned. Okay, and of course, this presentation is not has not been reviewed by the SC of Malaysia, so you will have to take it with this notice. Okay. Now let's get started. Now the first thing, like I said earlier on, was the theme of inflation. So in the States, of course, we all monitor the US Consumer Price Index. Now in this chart, you can see Consumer Price Index has been climbing, and although we have a dip for the month of April at 8.3%, but again, you can see that this trajectory is telling us that even with a dip compared to the month of March, for example, it is still very elevated. What we are seeing right now is that inflation in the States is at a 40 years high. Now, 40 years high, if you have no perspective, it's back in the 1970s to late 1973 to 1979 period. Of course, you may not have, if you're not born then, okay, or you are too young to remember, maybe you really have no idea how bad was bad. In those days, I was already in the army, so basically I did not really experience the inflation during that period of time. My parents have gone through those inflationary period, and now that I look back at it, it could be the highest inflation our generation has actually faced. So it can be quite serious going forward, because I think policymakers have basically lost control, because the Federal Reserve has been very far behind the curve in actually trying to tackle inflation. Now, remember last year about this time, inflation is starting to creep up already, okay? And then what we've been hearing from the US central banks is this is transitory, meaning to say this is temporary, and it will somehow like fade away, and they're telling us nothing to worry about. Now, 1 year later, of course, now we know that inflation is raging away, and it looks like it's really out of control. And it has been exacerbated by events that has happened over the last few months. Now, first of all, we can see that inflation at 8.3%. Now, if you use back the way they compute inflation or the CPI numbers back in the 1980s, this number is easily double the actual number using the 1980 computation of the CPI numbers. Okay, so when you look back at the 1980s equivalent of the CPI, we are at double digit easily. So it is telling us that this is a very, very serious issue, and the Federal Reserve will have to tackle this. Like I said earlier on, they are already behind the curve. They only started to raise interest rates this year. Okay, although they have caught up, by taking a more hawkish view in terms of how to tackle the inflation, and that has already spooked markets, as we are saying. Now, here, of course, we have the Federal Reserve. Now, this curve is telling us, like I said, the Federal Reserve only started to raise interest rates at first by a quarter point, and that was in March this year. And then only this month, they hiked interest rate again by half a point. Now, where the interest rate right now is at 1%. Market expectation is that the Federal Reserve is likely to do 6 to 7 interest rate hike for this year alone. So now they have done twice. That means to say that if this expectation is to be carried forward, we may be looking for another 4 to 5 rounds more of rate hikes. And if that is the case, we are likely to see interest rates at 3%. So 3%, is it enough to tackle inflation if it's running at 8.3%? So we still have that gap, that gap may not be able to be covered this year. So if we cannot somehow get inflation to moderate a little bit, okay, then maybe next year we will probably see the same thing. So I think at the end of the day, the Federal Reserve will have to ramp up the interest rate hike. Now, the consequences of raising hike too fast, too soon will also be negative for equity markets, because markets do not like especially equity markets, normally speaking, do not behave very well in a high interest rate environment or in a rising interest rate environment. It typically tends to come off. Okay, so we are already seeing the effect, because within the FOMC itself, tonight at 2 a.m. in the morning, our time, we're going to be able to read the minutes of the last FOMC meeting. Okay, so we want to see within this minute itself how many of the voting governors is asking or is proposing a more aggressive interest rate hike of, let's say, 0.75. So if more of those voting members wants to raise the rate hike to 0.75, then the market is going to be coming down even faster. In fact, like I said, we are already seeing the 8th week of market decline. Okay, so for the last 8 weeks, including this week will be the 9th week, we are still seeing market coming off. So we want to be very aware about what are the implications of too hawkish of a stand by the Federal Reserve. Okay, so you can see that on May the 18th, the Fed chairman, Jeremy Powell, has already said he is going to raise interest rate to as high as is needed to kill off the inflation. So this is a very, very hawkish view, because inflation is at 8.3% last we know, and right now the interest rate is at 1%. For it to catch up to 8.3, that means to say that we are looking at potentially very high interest rates. Now, right now, what we are more concerned is that we may be facing an issue whereby the remedy, okay, does not necessarily match the inflation that we are seeing. Now, we all have to understand, if you go by classical definition of inflation, it means prices are rising because of rising demand. But what we are seeing this time in this inflation has got nothing to do with rising demand. Okay, so by raising interest rates to curtail demand, they may be actually applying the wrong medication to the patient. Okay, so what I'm more concerned is that they may actually kill off the patient by tipping the US economy into a recession. So the Federal Reserve right now have two balls in which they have to, they have to juggle. On one hand, they have to raise interest rate to be seen to be trying to tame inflation. Whether or not they will succeed, nobody knows. In my opinion, because personally, I believe that this inflation is due to a supply side issue, not so much a demand side issue. Okay, then when you apply higher interest rates, the economy is going to suffer. So instead of tackling inflation, we could have a situation in which we still have very elevated prices and at the same time very slow growth. If that is the case, then we are looking at a classic example of a stagflation. Now, stagflation can be very, very stubborn to undo. Just look at Japan. Japan has been living in a stagflation for the last 3 decades. They have tried everything. They have tried QE, they have tried negative interest rates. Nothing seems to work. So stagflation is a very, very scary thing. Okay. So right now, what we are seeing is that this is the projection of the interest rate hike. If we go by market expectation of 6 to 7 interest rate hike for the year 2022, we are only in the month of May. So we have about 7 months more towards the end of the year. So if this is the projection, if interest rate hit 3%, this is the chart that we are seeing. You can see that the dotted red line is the projection of this interest rate hike. Okay, now we have done 2 rounds of interest rate hike, and if you go all the way to December, we are possibly looking at 3%, and 3% may not even make a dent in the inflation itself, because there are other factors that is driving inflation other than demand, in which I think policymakers right now everywhere is basically having the same approach, and I think that is going to be catastrophic, because like I said, they may be applying the wrong medication for this patient. Okay, and the patient being inflation, of course. Now, when you look at the retail sales, US economy is made up of 70% retail sales, and if the retail sales is not doing well, it will mean further down the road the GDP will not be good. Okay, so now we have on the left the retail sales up to the month of April. Okay, so you can see the retail sales has already been flatlining for March and April. Yes, already gone flatlining. Okay, so this is a worry, because when you look at January, we have quite relatively good retail sales number. Okay, since the start of the war in Ukraine, you can see the retail sales has gone flat. And if they go negative, okay, then that could be a sign that the economy is not doing too well. Okay, so when you look at the chart on the right, that is the GDP, and the GDP is released every quarter. So we have the first flash estimates, and it came in first quarter was a horrible number. It was negative 1.4. Look at where it was at Q4 last year. Okay, it's at 6.9%. Now we are in negative 1.4. So now it's saying that if we have another quarter, which will end at the end of June this year, okay, we will have maybe by the month of July, we will see the flash estimate for the Q2 GDP. And if we have 2 quarters of negative growth, it is the classic example, definition of a recession. So the US, not only US, I think globally, when you look at their GDP numbers, we can see that most of the major G7 economies are having the same situation. Very, very weak growth, very elevated prices as far as consumer price is concerned. So we are globally, we are seeing this. Okay, now like I said earlier on, there are other drivers that's causing this inflation to be very, very stubborn. No, so the Federal Reserve will have to walk a very tight rope. Okay, on the one hand, you have inflation concern. Okay, and the other hand, if they raise rate too fast too soon, they run the risk of tipping the economy into a recession. Now, don't forget, this year in the States, they have a midterm election come November. So this will be crucial to the incumbent party in control. In the States, it's the Democrats that's in control of both chamber of Congress, the Senate, as well as the House of Representatives. So if inflation continues to stay high, or the economy tip into a recession, either or is not going to be good, because if that being the case, they may run the risk of losing both chamber of the Congress. And going forward, for the rest of Biden's second half of his term, that means he will be a lame duck president, because nothing will get passed through Congress. Okay, so this is a very scary situation. We are at the moment in time whereby this twin evil, inflation or recession, neither of them is going to offer any relief to the American, basically. Okay, so that will of course transpire to people like you and me in this part of the world suffering imported inflation, because when the Federal Reserve raise interest rates, they have sucked up all the funds from overseas, whether it's in Europe, whether it's in Asia, whether it's in Japan. Okay, especially in Europe and Japan, because both central banks in these two places are keeping their interest rate policy at the current level, which means it's negative interest rates. So when on one hand you have US Federal Reserve raising interest rates, now capital will flow to where they can get a better yield. So if the US central bank interest rate is continuing to climb, or is expected to climb, then money will find a way into these high yielding currencies. So once the capital hit the US, it's not going to stay in US bank. It's definitely have to go somewhere. So right now the safe haven seems to be going into bonds. Okay, so this is what we are facing right now. Okay, now another sign that we are in serious trouble is, from the various key decision makers within the economy itself. Of course, here we have the former CEO of Goldman Sachs, okay, Lloyd Blankfein is telling us that the US is running a very, very high risk of going into a recession. So this is a person who is very well connected, and he knows what he's talking. So he's telling us that US is definitely looking at a situation in which they are looking into the abyss. Okay. Then of course we had the former Federal Reserve Chairman Ben Bernanke also saying that we're going to have a situation very similar to 1970s. Now, what happened in 1970s? If you have no recollection or you're too young then, 1973 to 1979 was when they have an oil shock. Very similar to what we are having now. But the oil shock then was very different. That was due to the OPEC members, imposing an embargo. Okay, so basically that causes prices of crude oil to actually escalate. But when you look at crude oil prices, currently we are looking at more than $100 per barrel, and it looks like the war in Ukraine is going to make the the whole issue even more intractable. So going forward over the next few months, nobody see that the war in Ukraine is going to ease anytime soon. So prices will be under pressure, okay, whether it's commodity prices, whether it's energy prices, and this will eventually, you know, play out in the retail scene in terms of higher prices. We are already seeing many countries basically are not allowing export of key commodities like wheat. Okay, in India, they have already stated that they are not going to export any wheat for this year. Of course, because if wheat prices is going to go higher, why should you export? You know, you want to benefit from the higher prices. So is OPEC. OPEC is looking to maintain production at the current level, not increasing supply, so that they do not necessarily want the cost price to ease back. Okay, so when you look at all these factors, you already know that inflation is definitely going to be remaining. It's going to remain with us for the rest of the year, maybe into next year as well. So this will have consequences. Now, the other thing is that we have last few months, we can see over the last 2 months, Shanghai basically locked down because they have this zero COVID policy. And Shanghai is a major city. When you lock down Shanghai, you lock down Shenzhen, you lock down Guangzhou, okay, and Ningbo, which is the one of the 2 major ports in Shanghai. Shanghai ports as well as Ningbo. When they shut down, nothing get loaded, nothing get unloaded from the ship. Okay, so you can see on this chart here in the circle, you can see those are the configuration of ships that are stuck, okay, near the port of Shanghai. So it's a very scary. Of course, now we know that Shanghai has slowly opened up, but not 100% yet. But we can see that this thing will have a knock-on effect in terms of supply coming up from China. Now, China is the factory of the world. If China cannot export their goods out, eventually worldwide, we're going to have a shortage of everything, from raw material, from semi-finished products to finished products. So over the next few months, this thing will play out, okay, in higher prices at the retail level. So this is another reason why I am not very optimistic that we can see inflation easing, even with higher interest rates. Okay, then we can see that this is a report by Fitch Ratings, is already saying that the lockdown in Shanghai is going to cause a global supply chain disruption. It's already disrupted, okay? Now it's going to get worse. So this is more evident to say that inflation is definitely not going to ease anytime soon. Of course, the other wild card will be the war in Ukraine. Now, it is still ongoing. We are now into the 3rd month of this war. And we all know both Russia and Ukraine are major exporters of key products, okay? For example, grains. Between Russia and Ukraine, they contribute something like 30% of the worldwide supply of wheat. So going forward, this supply will not be able to come to the market because the war in Ukraine right now come to a point whereby it's planting season and they cannot plant because all the guys are fighting the Russian to defend their own country. So basically, nothing is being planted this year. So come harvest time, there will definitely be a shortage. Even those that has been harvested, now they have no access to the port. The only port left for them now is Odessa. Now the war has moved on to Odessa. And if the port is being sealed by Russian troops, then basically nothing gets exported. And on top of that, there are other key components, okay? Fertilizer, for example, Russia is a major supplier of fertilizer, up to maybe 50% of the world supply. Now, if Russia cannot supply the world with fertilizer because the West has actually sanctioned, okay, Russia export, so nobody can buy anything from Russia. So the fertilizer cannot be exported out. Farmers will definitely see the crop yield actually collapse because without fertilizer, you cannot have good harvest. Okay, then we can see that between these 2 countries, these are the major commodities that will not be available in the marketplace. Okay, and this can be quite significant from cooking oil to grains. All this will not be available. So whether it is your pasta, whether it is your meat, your goreng pisang, okay, all those will not be able to be had. Okay, then of course there's this other thing called the industrial gas called neon. Neon, okay, is what is crucial and indispensable in the laser for the manufacturing of microprocessor, the microchip itself. So Ukraine contribute like half of the world supply of this gas called neon, and now this basic gas is no longer available, eventually we already saw very high prices in microchips. Okay, so this is going to make the inavailability of these microprocessors contributing to the tightness in the microchip itself. So definitely this will have implications. Okay, now we come to the segment, and I want to share with you my opinion of the various markets here. Okay, again, I want to remind you these are my opinions, and I'm not necessarily telling you that this is something that you should also follow. You can take it into advice and then use your own analysis. Now, first of all, we want to share this cash index first. Now, this is a chart for the weekly time frame for the S&P 500 cash index. Now, we can see that the market is basically bullish. Now, if you do not understand why I have a green color box and pink color boxes, this is my way of looking at whether the market is the underlying strength is favoring the upside or the downside. Okay, I'm not going to go into strategy. I'm not going to show you how to explain to you why the green box is green in color and why the pink box is pink color. Basically, the green color box is telling me the underlying trend is up, and the pink is telling me the market is coming down. So if the larger box is green in this case, okay, then it says that the underlying trend is still up. Now remember, this is a weekly time frame. The low here, 2191.86, is the low of March 2020 when the pandemic hit. That was the low. Remember that we have a flash crash. Immediately after the WHO announced that COVID-19 is a pandemic, the market have a very sharp crash, and it lasted only 1 month. And then before it started to recover, the low was 2191.86 in the cash market. So this continued all the way to this year. On January the 4th, the high traded for the S&P 500 was 4,818.62. This is again in the cash index. Since then, the market has been declining. Okay, so the all-time high in the S&P 500 was traded in January the 4th this year at 4,818.62. Since then, the market has been coming up to last week. Okay, we see the low at 3,810.32. This is the lowest since we have been tracking this for a year. Okay, so we can see that this low here is about the low compared to last year. Okay, and this week itself we have a bit of a rebound. Okay, so will the rebound be the turnaround, or is this just a rebound? Okay, if it's a rebound, it means to say that market eventually will come back down again. Okay, but if it's a reversal, there is a chance the market can go up to new high. But based on the fundamentals so far, it doesn't look like the case. Okay, it's more like a case whereby so far, technically speaking, this is a three-wave pullback. Now, in a three-wave pullback scenario, this is a classic technical retracement. Okay, so the underlying trend is up. So the trend is up. This is a technical correction, three-wave. Three-wave is always very corrective. If you have any understanding of Elliott wave, you know three-wave is a corrective wave. And the market has gone into equality. Yes, slightly more than equality because the target was 3,933 to 3,843. Market have a low of 3,810. Okay, of course, this is not an exact science. Okay, it just gives us an idea where the market can move to. Okay, so we can actually make a forecast for that. So basically, the market has hit a low of 3,810 and then starting to rebound. So the rebound right now is very, very tentative. Okay, so once you look at this, we have to go down to a lower time frame. Later on, when I'll show you the lower time frame in the equivalent micro E-mini futures contract itself. Yeah. So for a time being, I just want to show you the larger picture in the cash market. The other market in which I want to share with you is, of course, the Nasdaq. This Nasdaq is the leading market that's coming down. Okay, we all know there are 4 major equity index that you can trade using the futures contract. We have the S&P 500, we have the Dow, we have the Nasdaq 100, and then we have the Russell 2000. Now, when you look at the various equity index, they are not created equal. Over the last 8 weeks or so, we can find that when the market decline, this is led by the Nasdaq. And that is rightfully so because the tech stocks, okay, has been leading the way down. Last night we have another sell-off in tech stocks. Okay, not to try the low of last week, but again we can see that the market is actually very jittery. We have this stock called I think it's called Snap. Okay, in one day itself it lost 43% because the earning. Right now we are in the earning season. Okay, so we continue to get reports of the various results from the various companies. So the focus has been on tech stocks, and Snapchat last night reported earning the missed estimate by by quite a while, by quite a bit, and the market sold off very aggressively, and that brought down the Nasdaq 100. You can see the Nasdaq 100, the low traded last week was 11,035. Market have a bit of rebound, but it's coming back down. So you can see that over the last few bars here, each bar represents 1 week of trading. So you can see 3, 4, 5, 6, 7, 8. We are now into the 8th week of decline, and it looks like it is getting, it is not finding a bottom yet. Okay, although it is very, it has almost hit the equality level in 10,990 to because the allowance is for this market to go down to 10,990 to 10,525. This will be the allowable range of prices in which I think they should be able to find some kind of demand. Okay, and then there's a pivot point here at 10,825. So we are not that far away from finding a bottom. If we can find a bottom here, accompanied by a bullish reversal bar in the weekly time frame, then we can conclusively say yes, demand is coming back. Then maybe we can play the rebound so far. Okay. Now the other one we want to take a look, of course, will be the main index, the Dow Jones. This is the granddaddy of US equity index. You can see that this is by far the firmest. Other than the S&P 500, the Dow Jones is the one that declined by the least. And if the market goes up, it will go up more than, let's say, for example, the Nasdaq. So when you want to either go long or go short US equity index, my preference is this. My preference is to buy either the Dow or the S&P 500. And if I want to sell, my first choice will be Nasdaq or the Russell 2000. So this is a bit of a difference in terms of the dynamics affecting the major equity index in the States. Okay, so you can see the market here hit a low of 30,635 and then rebound. And then you can see this rebound lately is currently being played. This chart is updated to 5:30 p.m. today. Okay, so of course, in the off-exchange trading hours, like in Globex, this market is being traded. So this price that I'm showing you is up to 5:30 p.m. this afternoon. Okay, so it is ongoing. So this market is basically also having a three-way pullback, and it has hit equality level. So there's a very good case for a market to rebound. Again, how far can the market go back up to? I think this pivot point at 33,227 is going to be key. If the market cannot close above this point, okay, then it is again a good candidate for market to sell off, especially if the sell-off continues in the tech stocks. Now, over the Russell 2000, this is a small cap index, okay, and it has gained popularity late last year. We can see that the volume has actually picked up quite significantly for the Russell 2000, and it is mimicking the move in the Nasdaq 100. Okay, the low traded was 1,701 and the market rebounded, but it didn't quite rebound very well. You can see last week itself, it did not create a new low. Now, if you have observed the last three charts, the low was traded last week for the S&P 500, the Dow, and the Nasdaq. But for the Russell 2000, the low was traded 2 weeks ago. Okay, so last week we did not have a low for the year. In fact, the market actually managed to trade off the low, and this up to now the market is sliding back again. Last I checked was 1,764.8, and the market is looking to is sliding back again. Now, always do this very simple. It's all about common sense. Okay, when you want to buy, you want to buy the strongest. When you want to sell, you sell the weakest. Earlier on, I've highlighted the fact that the Dow and the S&P 500 are the firmest. If I want to buy, I will buy these two will be my my products of choice. And if I believe the market is continue to weaken, then my choice will be either to sell the Nasdaq 100 or to sell the Russell 2000. So this is common sense. You buy the strongest, you sell the weakest, regardless of what you are trading. Okay. Now the other thing is a little bit of the contract spec itself. Now there are 4 micro E-mini equity index from CME in which you can trade. I started trading the S&P 500, the big one, back in the early 90s. Okay, in those days there is no E-mini. It's just basically one contract, and of course we know the nominal value for the index itself has gone up by more than 10-fold. Of course, the margin required is based on the index value itself. So obviously, if you compare the value of the S&P 500, let's say 30 years ago, and now, obviously the nominal value has gone up, and of course the margin required will be very, very significantly higher. So it would have priced out most of the retail traders. So that's why they launched the E-mini contract, and E-mini was instantly one of the most popular equity products that ever been launched by CME. In fact, equity index futures is one of the most successful traded contracts anywhere in any exchanges. So especially in the CME, E-mini was immediately welcomed by retail traders. And then by now, we already know that the index has gone up again from low of 2009, 2020 until now. It has again doubled in value. So of course, the margin required to trade the E-mini has again become out of reach for you and me. So when the CME launched the micro E-mini, that was perfect because they launched it before the pandemic hit. So straight away, they don't have to rush out a new product. Instantly, retail traders like you and me will have access to this marvelous product because the margin required is not significantly higher. Okay, if you are preparing to hold overnight, when you look at the micro E-mini S&P 500, you know that the maintenance margin to hold one lot overnight is 1,120. And if you do not want to hold overnight and you want to do intraday trading, the margin is only $140. Okay, so it is very, very within the reach of you and me. Okay, and the point value, of course, is cut down by the size of to reflect the smallest contract size in the micro E-mini. 1 point is equal to 1 point in the S&P in the micro E-mini S&P 500 is 0.25 equal to $1.25. This is by far the largest contract among the 4 available contracts. So if you are if you like the volatility, then maybe you can trade the micro E-mini S&P 500. The other one you can trade, of course, is the micro E-mini Nasdaq. This is also very, very high volume. Later on, I will show you the volume traded over the last month or so. Okay, so in this one, every quarter point is equal to 50 cents. So it's a very, very small contract. If you want to hold position overnight, the maintenance margin is probably the highest. Okay, it's $1,550. But if you only want to do day trade, then it's only $230. Very, very affordable. And the other one that is also beginning to pick up some interest, and I must say the micro E-mini Dow has by far the lowest volume traded. Okay, purely because the other two are more well known. Okay, like I said, currently the market seems to be focused on the Nasdaq, so the interest in Nasdaq is actually very, very high. S&P 500, obviously, no need to say, the interest has always been there. Okay, but the micro E-mini Dow is not as popular compared to the others. Okay, but still it is a very tradable contract. Every half a point move is equal to 50 cents, and the margin required for overnight in terms of maintenance is only $850, and if you are doing day trade, it's only $150. Very, very affordable. Now, the other one that I mentioned that has been seeing a lot of interest of late is the micro E-mini Russell 2000. Again, this is a small cap index. The popularity of this product can be seen by the rising volume. Okay, and what 0.1 point is equal to 50 cents, and it is again the most affordable equity index futures as far as a micro E-mini is concerned. It's only $550 for overnight trade for maintenance, and if you want to do day trade, it's only $140. So it is very, very accessible to you and me. Now, this is the charts for the daily time frame for the various equity index, micro E-mini index. Okay, I'll start off with the Dow. Where I said the Dow is the firmest of all the 4 equity index. So if this is a market in which I want to buy, you notice that this market here, last Friday, it closed in this form. Okay, the market traded a lot of 30,588 and then closed as a long-legged doji. Okay, for those who are familiar with the candlestick bar itself, this is a classical reversal signal. And coming on the fact that this is at equality level of 30,745. Okay, yes, it overshoot by a little bit, but the fact that it actually closed as a bar like this is telling us there is potential for the market. Maybe we have seen a temporary bottom. Okay, so going forward, we would like to see a rebound. So far, the rebound has been playing out today. Over in Globex, we have a marginal high although at the point when I track this thing at 5:30, the market has come off a little bit from the day high. But by and large, you can see that Monday there was follow-through buying. Yesterday there was a follow-through buying, although at one point the market was coming down. Remember earlier on I tell you, Snapchat estimates the earning reports misestimates by a mile. Market actually sell off, but towards after midnight itself, the market actually recovered. So if you watch this market beyond midnight our time, you can see last night the recovery started after midnight and it managed to close on a positive. Okay, meaning to say it closed above its opening price and setting the stage for another run up, because you see yesterday price, this bar here is again a pin bar. This is a very bullish pin bar. On top of this bullish pin bar here, we can see that this market is calling for a rebound. So I won't be surprised over the next few days we can see higher prices. Again, next week we have the non-farm payroll, so it could actually continue to trade higher all the way until non-farm payroll next Friday. Okay, so the top side for me, the level in which I think will be crucial will be this level at 32,577. Okay, beyond that we can see 32,693. So between these two levels, okay, of 32,577 to 32,693, I think this will be an area in which it may cap further advances. Now this can only be seen as a technical rebound. This chart here, you can see that the bigger this market actually started to come off, okay, in a three-wave pattern. Okay, so this is considered to be a corrective pattern. You can see that the underlying big box here is green in color, meaning to say that as far as the Dow is concerned, the underlying directional movement is still favoring the upside. Okay, so for now we can only say that this is a technical pullback, and within this technical pullback we may have another pullback up to this level here. Whether or not it will be able to cap this run, we will have to see how markets performs. If at this current level, at the level of 32,557, if we see a reversal signal, then again I will want to re-establish my short, to take advantage of further downside, because the fundamentals are all wrong. Okay, now the other thing we want to see is, of course, now over here you can see that I have placed this one so that you can have a good reference. Okay, and for the daily trading range, why this is a very tradable market? Yes, the margin requirement is $850 for maintenance overnight trades. Okay, but you can see that the daily trading range is very respectable. On the average is about 600 points on the high and the low. So when you consider that 1 point, 0.5 is equal to 50 cents, one full point is $1. So you can see that in terms of just one lot of micro E-mini, these are the potential for just one lot. Okay, if you are more aggressive, you can trade multiple of one lots, because these are very, very small size contracts. So you can see that there is range. Of course, it's going to be highly unlikely that you are able to buy the bottom, sell the high for the day, but you can see that there is enough range for you to do intraday trading. Okay, now the other one will be the S&P 500. This by far the most popular of the equity index that can be traded as far as US equity index is concerned. You can see that the bar here is the same thing. Last Friday, the market ended as a long-legged doji, and the market hit a low of 3,807.5 and then rebounded. On Monday, there's follow-through buying. Yesterday, it closed marginally weaker, but it ended up as another bullish pin bar. Now, this color bar here, I would have preferred it to be green color, okay, meaning to say the market closed higher than the opening price, but unfortunately it did not. But still, by and large, it is seen as a bullish setup. Okay, so there is still some upside potential here. As far as this chart is concerned, 4,100 is going to be the key, okay, because this is the pivot point, and you can see the market having some kind of reaction here. Okay, previously when the market rebounded, it just cannot go above 4,101. Okay, so this could be another level of resistance going forward, at least in the medium term. So for this market, you can see the trading range is not as wide, okay, but you can see it is still a respectable numbers. Okay, you can still afford to do multiples of multiple lot rather than do one lot. You of course will not be able to see enough P&L to make it to basically excite you. But if you can do multiples, this contract allows you to do that. Okay. Now, Nasdaq is one of the most popular in terms of rising volume. Later on, we'll go to the rising volume and you can see that, okay? And this market here, last Friday, it did not close very, very bullish, okay? It still managed to close, not like the S&P 500 or the Dow Jones as a bullish setup. So you can see there was no follow-through buying on Monday. Nothing, yesterday, it did not even close back up to as a positive. In fact, it closed as a negative compared to Monday's closing price, and currently the market is still sliding. So again, this is a market to watch. If the market is going to come off, the market is very jittery because tech stocks is still under a cloud. Okay, basically all the weak sentiments is coming out from the Nasdaq itself. Now, for this itself, you can see that the point value, 1/4 point is equal to 50 cents, and the maintenance margin is the highest, okay? Because you can see that the point value, the nominal value is in 5 digits. When you compare it to the S&P 500 or the Dow, it is nowhere near here. So basically, this basically is telling us it requires higher margin for you to hold overnight. But for day trades, it's $230, which is very, very affordable. Okay, and this one have no counter trend. You can see the market dominant trend is down, and there's no counter trend at all. So basically, this market is very, very weak. But do understand the market has hit equality as far as I'm concerned. Equality is at 11,444, and the market hit a low last Friday at 11,491. So it almost hit the equality levels. Again, this is not exact science, okay? So you cannot say, okay, because the market missed by a few points, therefore it is not considered as hitting the target. It has already hit target, in my opinion, okay? But we want to see whether it has enough strength to go higher. But so far, from what we can see, it's looking to be tough, okay? Upside potential is at about 12,954. So the 13,000 level is going to be hard to cross over. In the Russell, we can see something very different. The Russell did not have a low last week, okay? The week it was traded 2 weeks ago, okay? The low as 1,697 was traded 2 weeks ago, and we do not have any particular setup. But the good thing going for Russell right now is that it potentially, if you look at a 1 hour time frame, this is potentially getting ready for another run up as a 3-wave rebound. And if that's the case, I think 1,900, the level 1892, okay, is going to be key. It's likely to act as a very, very topside heavy resistance here. And this one has the smallest point value, so you can see that you can afford to do more than one lot, okay, for the micro E-mini Russell 2000. So there you have it. These are immediately my view. So when you look at the popularity of the four different equity index available in CME for trading, you can see that the micro S&P 500 has a registered trading volume per day of more than a million contracts a day. Okay, even open interest is very, very healthy. Okay, then when you look at the micro E-mini Dow, the volume isn't that great, and that is also a reflection of the popularity is biased towards the S&P 500. It has been one of the earliest product to be able to be traded. Then you can see that the other one that's everyday trading volume is above a million contract traded is the Nasdaq 100. So between the two, the S&P 500 and the Nasdaq, if the market is going to go up, I am going to put all my ammunition on trading the micro E-mini S&P 500. If my view is negative, I think market is going to come back down, then I will be more keen to trade the Nasdaq 100 because both of them have fantastic volume. Okay, one of the things that you want to decide which one to trade is to look at the volume, because volume is a sign of liquidity. Now, when you want to trade, you want to eliminate as many risks as possible. When the market is liquid, it means the spreads are very, very tight. So if you do a market order, you don't have to give up too much advantage to get in or get out of the markets. Okay, so that actually brings down your overall risk. Imagine if you're trading a contract that has very little liquidity, okay, in terms of volume, then every time you want to do a market order, you have to give up a lot of advantage because the spread will be wider. So between the 4 contract itself, it seems that the market is voting with their feet, okay, in the micro S&P 500 and the Nasdaq 100. The Russell 2000 is beginning to be respectable, but the trading volume is nowhere near those that we have seen in the Nasdaq 100, okay. So over the last couple of weeks, you can see the volume has actually tapered down, okay. Now, if you need to have more education, you need to know more about the product. Now, this is a website from the CME. Then the link is over here. You want to take a snapshot, take a screenshot of this, and then you can see that you can basically go and look for more information. Now, if you want to know more about education itself, you see they have courses for you. There's even webinars within this website itself that you can actually use. There are a lot of resources that you can tap into. Okay, there's even a trading simulator if you want to. Okay, so there's a lot of reviews. There's a lot of analysis, and you do not have. You can basically follow the analysis and get a hang of what's really happening in the market itself. So it's a very, very useful link. Okay. So this is the portion where I will take your questions. So if you have any question, do keep them coming. Okay, I'll be here to take your questions. Abigail?
Yeah, okay. Thank you, Daniel, for your sharing. I think you've done a very great job summarizing the fundamentals and gave a good insight on the outlook, especially with the probable near-term rebound. Okay,
Yes.
I believe our audience had a great time learning from you. So I think we'll go into the Q&A session right now.
Yes.
Oh, yeah, so the audience, if you have any questions, do type into the box and we will answer them. Okay, we have a question here from Hong Kong. It says like, Daniel, since you mentioned that the Fed may be using the wrong approach in raising the interest rates, what in your view would be a better approach to curb inflation?
The issue is money supply. You know, right after the pandemic hit, especially when Biden came to power last January, the first thing he do was to ramp up fiscal policy. I mean to say that they have actually issued thousands of dollars in checks, okay, and mail it to every American household, and that created they blow up the money supply, okay, and the issue here is money supply. Too much money is floating around in the marketplace, okay? So they will have to find a way to taper. And the Fed has already said that come June, okay, come June, they will not only raise interest rate, they will start to reduce the balance sheet. And the balance sheet has exploded, okay, during the pandemic. One of the things that they did was two things that they did wrong. Okay, first was to lock down the borders. When you lock down the borders and ask people to work from home, nobody can go back to the office. The retail scene go into a standstill. Basically, all the F&B died. Okay, all the services and businesses that depend on consumers coming into the shop, they all basically disappeared. Okay, so that brought down the reduction in consumption. Okay, then the other thing they did wrong was to go into excessive QE. And the QE is in the trillions of dollars. Over the 1 year period, they have bloated up their money supply. You look at the Fed balance sheet, you'll be astonished. The Fed balance sheet is at more than $9 trillion. Now, you can imagine before the start of 2008-2009 financial crisis, the Fed balance sheet was below $1 trillion. Below $1 trillion. Now it's at $9 trillion. So when they solve a problem, they created, or basically they laid the seed for the next crisis. So the solution that they actually employ by going to QE, okay, to resuscitate the economy in the aftermath of the global financial crisis, lay the seed for this current crisis that because just when they are looking to regularize the interest rates, okay, and they want to bring down what they call tapering, right? The market went into a seizure when the Fed actually lower interest rates from the effect of the rise in interest rates. No, when they cut down interest rate to almost zero at the height of the pandemic, okay, and then when they start to taper, the market went into a seizure, what we call the taper tantrum. So the Federal Reserve got scared and then they stopped doing their tapering. Okay, so now they need to bring down the overall size of the balance sheet. At $9 trillion is unsustainable. Imagine interest rate is going up. So what it means is this: the U.S. national debt has ballooned up to more than $30 trillion. Can you imagine every half a point interest rate hike is going to create how much burden just to service the national debt? If the current trajectory says that US interest rate will likely be at 3%, it's going to blow the national debt out of the water. So it is an impossible game. Okay, do they die? Don't do also die. So going forward, it's definitely going to be a very dark period as far as you're concerned. But if you look at the technical outlook of this market itself, the underlying trend has not been damaged. If you look at the monthly time frame, the weekly time, of course we don't trade the monthly and the weekly time frame, but you can see from those higher time frame that the underlying bullish market is not over. The market must come down a lot, okay? Come down below the March low of 2020 to even compromise the long-term bullish outlook. So right now we are likely to go into a period of decline in US equities, okay? So long as it doesn't take out the low of 2020, I think we are still safe. But if the market decline and take out the low of 2020, which is the March 2020 low, okay, across all 4 major equity index, that will be the sign that something else is moving. But for a time being, there is still a very good chance that eventually over time, okay, this market can run up to all-time high again, because I do not believe the bull run is over, because they cannot live with low credit. The market is addicted to low credit, okay, zero interest rate. Eventually, when the market, if the Federal Reserve continue to high interest rate beyond 3%, for example, when the US economy go into a recession, I tell you, I can bet you, the Federal Reserve will stop raising interest rate. They will undo everything and go back and start to lower interest rate, and that will cause the market to run up again. Okay, so of course we do not know what will happen in the war in Ukraine, whether it will escalate to something else. We do not know. But based on the chart itself, I think there is still that case for an all-time high, but not now. Okay, the market will still have to come off. Okay, and how far it will go down, I do not know. But at least for this year, I don't see the market rallying to all-time high. Not this year. Maybe not even next year. Okay, so overall, the next few years is basically we are still in a very larger degree corrective pullback. Next question.
All right. Okay, thanks for answering the question. So next we have a question from Philip. His question is, what is the outlook for the next 6 months? Referring to the US business lah. Yeah.
Okay. Assuming nothing, the war in Ukraine doesn't get from bad to worse. Okay. Assuming that is constant at the current situation. Purely looking at inflation, I do not believe inflation is going to be tamed by raising interest rates. Okay, as they raise interest rate, they try to at least have a semblance of telling the world that I'm doing something about inflation. Like I said, it's the wrong medication for the current situation. And just looking at it, I think every rebound is I would sell. Okay, basically I would look for level to sell into any kind of rebound. Okay, because I do not believe that the market has turned around. Not now. Okay, because the fundamentals are all wrong. So for the next 6 months or so, I still see prices coming back down.
Okay. All right, so I think we will take the last question because of time. I think this question is from Andy. I think it's a bit similar with Philip's question earlier. So his question is, if we expect the Fed to continue to raise interest rate and draining the liquidity, would you still buy at the current level? And where are you looking for the floor for S&P 500?
Okay, I will only buy as a day trade because this is a rebound, a technical rebound. We do not know whether it has enough momentum to sustain. So if I ever buy is on a day-to-day basis, I will not be looking at least to hold position for the medium term. Okay, so when I say that, I will be looking at a lower time frame. I could be looking at a 1 hour or maybe looking at a 5 minutes, because I'll be scalping the long side of this market for the technical rebound. By and large, I want to sell. So if I see the higher time frame, especially the daily time frame, started to show me the market is non-sustainable, market looks like it's going to come down, and if I see a bearish pin bar, for example, especially at key levels, then I will switch my strategy from scalping on the long side to basically not only short selling on the short term, but I will also likely to hold position for the medium term. So
okay,
this is
okay.
what I do.
Yeah, go ahead.
Any other question?
I think we'll stop the question from now because of time. I think some of the questions are not quite related to the your topic tonight. So okay, thanks.
Now, for those who have other questions, do know that every Sunday I do have a free to attend webinar at the same time at 8 p.m. Singapore time. These are the login details. If you are interested, you can take a screenshot of this, and I will be sharing a lot of outlooks for across a lot of markets, not just the US equity markets. Because I track everything. I track interest rates, I track energy, I track precious metals. You know, so I track a wide range of markets. And because I believe markets are all interconnected, so not all the time the market will be the action will be in equities. So sometimes I will toggle between different products. Just so if you're interested, you're more than welcome to log in, and you can ask me any question.
All right. Thanks, Daniel, for the info. Okay. So. Okay, I'm bringing back up this promotion again. So, you know, this promotion is regarding micro contracts. So Daniel did brief on the contract specs just now. And we know that micro contracts are actually very affordable. So if you like to long or short micro US indices contracts, so be sure to register for this promo to entitle for the rate of only $2.50. So you can scan on the QR code or can approach our dealers anytime, okay? And then to our audience, you can also connect with us on these platforms. You can find us on Facebook, LinkedIn, also YouTube by searching Phillip Futures Sdn Bhd. We are also on Telegram, and you can search us at Phillip Futures and join our Telegram. We post a lot of our market updates there, and we also consistently post updated news, events, promotions on our social media. So yeah, be sure to follow us so that you don't miss out on any updates that we have. And our recorded videos will also be uploaded on our YouTube channel as well. And this is our branches contact for you to reach out based on your location. So we have many branches across Malaysia. You can choose which one is nearer to your location, and you can take a screenshot if you like to. And if you have any enquiries, do feel free to contact us. For those of you whose questions may not be answered yet, you can leave them in the comments. We will get back to you after maybe tomorrow after the webinar. Yeah, and so I guess that's all for our webinar tonight, and we appreciate everyone for joining, and also thank you, Daniel, for your sharing tonight. So we hope to see you all in our future events again. All right, take care and bye. Yeah. Bye.